this lecture, we will cover the most important conclusions that we should know and use in everyday life on financial decisions. There are basically 5 important principles of finance which I would like to speak about, and especially one of them I would like to get your full attention on, which will be the time value of money. Anyway, first important issue is the cash flow is what matters. Second is that money has a time value. Third is that there is a positive relation between risk and return. Fourth is that the market prices are more or less reflecting correctly the value of a given stock. And fifth, there are conflicts of interest arising from the separate ownership and management of a company. Let's start to examine all of these principles. If there is one important lesson you should know from level 1 of One Academy, is that cash flow does not equal profits. It is possible for a firm to generate accounting profits but not have cash, or to generate cash but not report accounting profits in the books. Cash flow and not profits drive the value of a business. There is an old banker's wisdom which calls for always follow the cash. We must determine the incremental cash flow when making financial decisions, which basically means that we should consider the difference between the projected cash flow if the project is selected versus what will they be if the project is not selected. So just remember, profits are different. They are an accounting measure of the activity of the company, of the activity of the business, whereas cash flows are the real life dimension of the business. So when making analysis on the validity of a business or a business project or business activity, always try to look at the cash flows and try to analyze the real business instead of the accounting part of it. Second, probably the most important lesson and the most important principle. It will be covered in further details later in the lecture, but for now on you should know that money have time value. A dollar received today is worth more than a dollar received in the future. Since we can earn interest on money received today, it is better to receive money earlier than later. And we'll cover this topic a bit more in a few minutes. Third principle, risk requires reward. Assuming additional risk should require assuming or at least expecting additional reward. We won't take additional risk unless we expect to be compensated with the additional reward or return. Investors expect to be compensated for delaying consumption or taking on risk. Thus, investors expect a return when they put their savings in a bank, which is basically means delay of consumption. So they sacrifice some of their available funds, which they could consume, and then thus they expect some return on this action. Investors expect to earn a higher rate of return on stocks relative to bank savings accounts because stocks, as we already said, are assuming more risk than a bank account. So important takeout so far here is that every additional unit of risk that you take should require, or at least you should expect, additional return. There is a golden rule in stock exchange operations, and if you remember it, you will do just fine, and it is high risk, high reward. If you expect to assume high risk, this means that you should expect high reward for this. Of course, high risk means possibility for high reward, at the same time possibility for high loss. So this is what high risk means. First, in order to review this relationship between risk and return, or risk and reward, we will separately look into what is return and what is risk. Return refers to financial reward gained as a result of making an investment. The nature of return depends on the form of the investment. A company that invests in fixed assets and business operations expects return in the form of profit, measured on before interest, before tax and after tax basis, and in the form of increased cash flows. The easiest way to calculate return is to have the cash amount of the company or the investment amount of the company valued at the different point of time. First, the evaluation of the cash at the moment of investment, and second, at the evaluation of the cash or the investment at the current moment. And if we have these two evaluations, we could simply calculate the new additional return that we have had on this investment. How do we do this? We just take the initial investment, denoted here by C0, and put it in the denominator. And this means that we will divide on this basis. And on top of it, we are going to put the difference between the current value and the original value. So basically, we can simplify this by just dividing the current value of the investment over the initial value of the investment, and if we subtract 1, we will have estimation of the return. If this is a positive number, we have a positive return, so positive reward and some profit, respectively. And if we have a negative number, this means some loss. Obviously, definitely, profit is better than loss. Now, let's examine risk. Risk refers to the possibility the actual return to be different than the expected return. And of course, there are at least two different points of view here. The actual return being higher than the expected return, this is a welcome occurrence. This means better than expected. And it might be the case that the actual return is lower than expected return. This is a worse occurrence, worse than expected. In both cases, we might encounter high risk or low risk. So let me explain and now elaborate on risk. Although in the coming levels of One Academy, we will cover the topics of risk extensively. So there are two views on risk, the traditional view and the modern view. The traditional view states that risk is defined by the difference between actual and expected, which basically means if we have high difference in the positive direction, in the direction of profit, is as equally risky as having the same high difference in low direction, in the direction of losses. And the new view on the modern view of defining risk is only looking at the negative consequences. So we are only defining risk as a negative difference between expected and actual return. Investors, companies, financial managers are more likely to be concerned with possibility that actual return is less than expected return. And investors, companies demand higher expected return. Possibility of actual return being different from expected return increases. So it is a permanent struggle for wanting more return at the same time being afraid of taking more risks. Okay, now that we have covered the risk, we have covered the definition of risk, I have a small test for you. On this chart there are two graphics of two different investment securities. So take a moment, look at it, and think about which of the two securities is more risky. The one painted in black or the one painted in blue. Obviously, the one line that denotes sharper differences from one period to next period is the one that exemplifies higher possibility of difference between the expected and the actual return. So out of both cases, we have the black line showing the lower risk investment, whereas the blue line shows the higher risk investment. Also, we can see that if we time our investment right, we could earn considerably more on the blue line. So if we buy if we have bought the security at one of its lower points and we have sold it at one of its higher points, we could have made a huge difference. Whereas in the black, for the black instrument, we have smaller differences for longer periods. Fourth principle, it is stating that the market prices evaluate the securities more or less correctly. In an efficient market, the prices of all traded assets, such as stocks and bonds, at any instant of time, fully reflect all available information. Thus, stock prices are a useful indicator of the value of the firm. Prices changes reflect changes in expected future cash flow. Good decision will tend to increase the stock prices and vice versa. So, following the news stream about the companies, following its indicators, and also other stuff and all other news about it, we could use this information to trade on the market. But because everyone does, the market very quickly transformed the new information into a price change. Note that there are inefficiency in the market. There are still inefficiency in the market that may distort the prices. This is especially true for short-term periods. Principle 5. Conflict of interest calls agency, which means ethics problems. The separation of management and the ownership of a firm creates an agency problem. Managers may make decisions that are not consistent with the goal of maximizing shareholders' wealth. Agency conflict is reduced through monitoring, for example, annual reports, compensation schemes for the managers, for example, using stock options as payment method, so that the managers are interested in maximizing shareholders' value because they are shareholders as well, and market mechanisms such as takeovers, which basically means if our company is not doing well on the stock market but at the same time has interesting balance value, they are becoming, our company is becoming a target of takeovers. So the most important concept in finance is the time value of money. It refers to the fact that the value of money changes over time, and it could be explained very easy, taking a very plain example. Imagine that you are depositing in a bank $100 today, and you deposit it for 1 year, and then after a year has passed, you go to the bank and you expect that they return your $100 to you, but also you expect that there is something additional paid on top of it. This additional thing is called interest rate, and it is paid to you because it compensates the fact that you could not use or consume your $100 for the 1 year period. So it is only natural that you give $100 to the bank, and after a year you receive back $100+. So for example, if the interest rate was 5%, after 1 year you receive $105. And this is a fairly straightforward notion. It is the idea that if you sacrifice some of your flexibility and give your financial funding to somebody else, you expect that after a while you should be compensated. The future value is as follows. A valuation of $100 today, after 1 year, should be 100 plus something. When we're speaking about future value, this is the very simple formula for calculating it. It is the value of cash flow after several periods of compounding. So let me explain the formula. First of all, FV obviously corresponds to future value. FV equals C0. C0 means cash at the moment now. So whatever we have had in the beginning of the period is here at the C0. For example, $100. And then we multiply this with the so-called interest rate factor or interest factor. The interest factor, if we look between the brackets, is basically taking 1, which corresponds to the amount we have today, and it is summed up with the R, which corresponds to the additional interest rate that we should receive. Expression in the bracket is to the power of n, where n is the number of periods which this investment is compounded. So, for example, if we leave this deposit for 2 years, it will be compounded once after year number 1, and at the end we will have $105, for example, and then we should compound or accumulate the interest rate over the $105 instead of just $100. So this is why we have a power to the n. N corresponds to the number of periods. So basically this is how we calculate future value of funding gone through compounding of interest rate. Correspondingly, we could, of course, solve a case here. Let's assume that John places $800 in savings account paying 6% interest, compounded annually. He wants to know how much money will be in the account at the end of 5 years. So we have very simple, fairly straightforward calculations here, computation here. $800 times 1 plus 0.006, so it is 6% is 0.006 to the power of 5. And if we compute it, we will get the answer of $1,070.58. And this is the future value of the $800 we have today with this compounding. The other idea, the so-called present value, is somewhat opposite to thinking when we're describing the future value. So if we have an expected cash flow after 1 year, let's say $100, and we have at the same time in our pocket currently right now $100 in our pocket, in our possession, and if we compare the both cash flows, we will see very easily that the dollars that are currently in our pocket are disposable to us and are more useful and thus more valuable. So basically discounting is done whenever we would like to analyze how much an income that we expect to receive after a given interest of time should be estimated at the moment now. And obviously what would happen is that if we're expecting an income after a year, an income of $100, these $100, since we cannot consume them right away, are valuable less than 100 as of today. So this is the present value of a future cash flow. So now let's check the formula. Present value, PV, is equal to the cash at the end N period, and it is multiplied by the so-called discount factor. The discount factor is on the right. It is 1 over the denominator, which denominator looks very familiar because this is exactly in the denominator we have exactly what we had in the future value, which is the interest factor. And so if we make this example, let's assume that Pamela wishes to find the present value of $1,700 that she would receive in 8 years. Pam's opportunity cost, which means alternative possibilities for earnings, is equal to 8%. And if we make the calculations using the mentioned formula, we will reach to the conclusion that Pam's $1,700 after 8 years should be evaluated at about $918 currently today. So what Pam now knows is if she has $1,700 as of now in her pocket, how do they relate to the future value of $1,700? I will try to sum up here with the present value. Present value is the current dollar value of a future amount, the amount of money that would have to be invested today at a given interest rate over a specified period equal to the future amount. It is based on the idea that the dollar is worth today more than a dollar tomorrow, and it is called the transferring of future values to current values, to present values, is called discounting. There are other examples that we could review here. I'm going to show you the connection between compounding and discounting here on this chart. We have the present value at the moment now taken from a different, discounting the cash flows from different points of future time. Let's say we are discounting $3,000 from year 1, $5,000 from year 2, and so on. And we will arrive at the number of which corresponds to the present value of this project. And the same goes if we are trying to compute the future value of all these cash flows, the future value as of the year 5. And we can see that compounding brings us increase in value because it is more and more time passes and more cash flows are being put through interest rate. So as a general, what we have as a connection of present value and future value, you should remember one thing. They both represent the same idea. The value of money changes over time, and the dollar today is more valuable than dollar tomorrow. It is the same analysis, but for different points in time. Future value calculates the value received at a future point of time, whereas present value calculates the value estimated at the current point. So what did we do so far in our final lecture? We had reviewed the main principles in finance. First of all, cash flow matters the most, referring to the fact that we should watch after the real cash flow instead of accounting profits. Second of all, money has a time value and it changes over time, and $1 today is worth more than $1 tomorrow. And future value, of course, means that if we lend somebody money, we should expect increase of the return value, increase of value of the return money. We should expect compensation for this lending. We now know the notion that risk requires return, which basically means that assuming more risk requires more return. At least we should expect more return. We know the notion that markets are generally evaluating the prices of the securities more or less correctly. And we now know that there are conflicts between management and owners of a corporation emerging from the fact that managers do not always think that they should maximize shareholders' value. And of course there are some measures to be taken in the other direction. Basically, this concludes our lecture and the final lecture of the level 1 of One Academy. I would like to remind you what we were speaking in this level. We were speaking about Introduction to and Fundamentals of Finance. After that, we were speaking about money and monetary systems. After that, we were speaking on the importance and the role of corporate finance. After that, we spoke about the financial markets as an important allocator of resources. And finally, we spoke about the important financial principles. This was it for now. and I'm expecting you in the next level. Take care.